No signs, no signs at all of this bull market slowing down. We just passed the midpoint of 2024 and the S&P 500 is up 16.75%. That's a great return for an entire year, and we still have 6 months to go. Of course, some heavy lifting was done by names such as Nvidia, Broadcom, Eli Lilly, Meta, Google and Amazon did some damage as well. But remember, 16.75% is an average, meaning there has to be some big names lagging the rest of the market. Welcome to the Quality Investor. Happy 4th of July to my American friends. Have a safe weekend as we celebrate this great nation's independence. No matter what, there will be losers in the market. And since I seek to do better than the market average, anything below that average is a loser. So today, I want to discuss 3 big-time businesses that have woefully underperformed the market in 2024. However, it is how they've underperformed. Sometimes it's obvious when a business is in decline. Revenues are trending down, expenses are trending up, and cash seems to be disappearing. Look no further than the lowliest S&P 500 member, Walgreens, ticker WBA. Walgreens has been a whipping boy of mine in the past for their horrible management. They have lost a disastrous 57.5% in 2024, and their dividend aristocrat status lost along the way. But what if things are going well? Revenues are growing and the business is in high demand. We seek businesses with a wide economic moat on this channel, and one of my favorite tells for that is free cash flow. When free cash flow increases, the business is creating value, and increasing value means increasing returns for investors. Yet the businesses we're about to get into, all 3 have increased their revenues and free cash flows on a trailing 12 basis, yet in 2024 are lagging the S&P 500. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Each of these businesses have ultra wide moats. They are duopolies at worst. They dominate their respective markets. So while they may be staggering along in 2024, they are one good earnings report away from the boost they need to get back on track. I believe each of these businesses are poised to outperform in the back half of 2024. So who are we discussing today? We are looking into Intuit, S&P Global, and Visa. So without further ado, let's get into it. First up, we are looking at Intuit, ticker INTU. Intuit has actually been the best performer this year of these 3. They're up 9.3% year to date. You can see in the first 3 months of the year, they did do pretty well before faltering and then having a huge dip after their last earnings report at the end of May. Intuit has been on my watch list for a while, and the primary reason is because they dominate their market. Their 2 primary products are QuickBooks and TurboTax. According to this article here on June 5th, 2024, does Intuit's strong market share make it worth buying? They list that Intuit has an estimated 90% market share in its consumers tax preparation segment through its flagship product, TurboTax. Its QuickBooks accounting software holds a commanding 80% market share among small businesses. Its dominant market position, coupled with strong brand recognition, creates significant barriers to entry for competitors, solidifying Intuit's competitive advantage. But while those competitive advantages by themselves are great, Intuit also has a subscription model for its platform. And not only that, and I think this is what's going to be promising for the back half of 2024, they're increasing their prices for QuickBooks, which goes into effect on August 1st, 2024. Their current fiscal year closes on July 31st, so we're not going to see the effect of these price increases until their first quarter of 2025. And we can see that these price increases are quite nice. The self-employed base monthly price is currently at $20, which is going to $25, and their most advanced model, $200 on a base price, going up to $235 after the price increase takes effect. This to me demonstrates the pricing power Intuit has in their market. Given the fact that they are 80% market share for QuickBooks, they had that strong commanding pricing power, which again further demonstrates their very wide economic moat. And we can see here the strong growth Intuit has had over the last 10 years. You can see their trailing 12 revenues, gross profit, and operating income are all up. Their earnings per share on a trailing 12 basis is up. And of course, like I mentioned before, their free cash flow on a trailing 12 basis is also up. And just looking at the compound annual growth rates over the last 10 years for these major fundamentals here, you can see that they're all very strong growth rates, 10% plus in each of the major categories. I said earlier that they were up 9.3% or something like that on the year. Well, in fact, they're only up 5.58%. The discrepancy is because I'm basing my calculation on the close on December 29th of 2023, whereas Google was basing their close based on January 2nd of 2024. So I do think mine's a bit more accurate. Nonetheless, the fundamentals all look very good for Intuit. The only thing that gives me a bit of caution with them is their stock-based compensation. We can see that the percentage of stock-based compensation of free cash flow is actually quite high at 36.5%. That is definitely something we want to keep an eye on, and hopefully that can come down here in the near future. One thing to point out too is their margins, both gross and operating, have been declining slightly in the last few years. It's still a very healthy 78% gross margin and a 23% operating margin. We want to see that getting back up. And with that current price increase, Intuit should demonstrate its operating leverage. They shouldn't be incurring additional costs with a price increase. Therefore, it should be mostly profit that Intuit accrues from that price increase. That said, the free cash flow margin, has increased quite a bit since 2009, sitting at 21.9% in 2009, up to 32.32% today. And on a trailing 12 basis, they have a very healthy return on invested capital at 27.6%. And one more thing about Intuit, they have a very nice dividend. You can see they pay $3.60 per share. It's only a 0.5% yield. However, they should be a strong dividend growth stock in the foreseeable future. Their payout percentage on a 10-year basis now is only 21.5%. So there's a lot of room to grow that dividend. And you can see that free cash flow has increased a lot faster than the dividend itself. And on top of all that, you can see that their dividend increases are amazing, continually topping 10% annually. Next up, we're looking at S&P Global, ticker SPGI. You can see they've had a pretty choppy year so far. However, that doesn't change the fact that S&P Global is a powerhouse in three main categories: credit ratings, market analytics, and indexing. Their market intelligence or data analytics segment is actually their largest, with $4.3 billion in revenue, which accounts for 35% of S&P Global's revenue. Ratings, which is effectively a duopoly with Moody's, had $3.3 billion in revenues in 2023, which is 26% of their total revenues. And indices, whose major competitor there is MSCI, had $1.4 billion in revenue for 2023, or 11% of the firm's revenue. And like I said, they dominate the credit rating market share. They operate 40% of the market, along with Moody's, which makes them that duopoly, with the third closest competitor being Fitch Ratings at 15%. And in terms of index providing, they're essentially tied with MSCI at 23.8% of the entire indexing market. And like Intuit, one thing to really like about S&P Global is they have 55% of their revenues coming from subscriptions. Subscription revenue, of course, is very predictable and tends to continue growing. They also have 7% of the revenue coming from asset-linked fees, meaning they're taking a cut of all the assets under their management. These are both very stable types of revenue, and it accounts for nearly 2/3 of S&P's total revenues. And looking here at how S&P has performed for 2024, you can see their actual year-to-date return is 2% based on the December 29th close price. But like Intuit, they've continued increasing their revenues on a trailing 12 basis, as well as that free cash flow on a trailing 12 basis. And while their earnings have decreased a little bit in the last 3 years, they are back on the upswing now on a trailing 12 basis. And looking at their margins, you can see that, like I said, there has been that kind of a decline in the last 3 years, but they are back on the upswing for both their gross margin and their operating margin, as well as the free cash flow margin. They also have a very healthy 21.7% ROIC on a trailing 12 basis. And finally, S&P is another very good dividend growth stock. They are in fact a dividend aristocrat, and you can see that they have no problem covering their dividend with their growing free cash flow. You can see here on a free cash flow payout percentage that outside of that one spike in fiscal year 2015, their dividend is well covered by their free cash flow. It currently sits at $3.64 and yields 0.8%. And the last stock on this list today is Visa, ticker symbol V. You can see in 2024, Visa has been performing quite well up until about March 21st when it reached a high of $290.37. But since then has steadily declined. For the most part, the decline in 2024 has been around generalized fears of consumer spending as a whole, but just last week, a judge rejected a settlement agreement of $30 billion for both Visa and MasterCard. That has been a legal battle since about 2004. And while many thought earlier this year, while there was a resolution to that settlement with retail associations, clearly there is not. The swipe fee settlement judge says the $30 billion agreement is paltry. Court documents show that Judge Margot Brody says that the two companies seem to be able to pay for a substantially bigger settlement. She also argued that the proposed deal would have disproportionately and inequitably benefited small local merchants over large retailers like Walmart and Target. I found that last part very interesting. Disproportionately and inequitably benefited small local merchants over large retailers like Walmart and Target. That seems very backwards to me. Brody wrote that while the proposed settlement is $30 billion, the estimated $6 billion in annual savings to merchants is paltry compared to the $100 billion that merchants paid in interchange fees on Visa and MasterCard transactions in 2023. Both companies could withstand a substantially greater judgment, she added. A couple things on this. First, the language. She said the $100 billion that merchants paid on interchange fees. We'll come back to that in a second. Secondly, the market is reacting to an agreement that was effectively denied, meaning the status quo prevails, at least for the foreseeable future. So it's business as usual for both Visa and MasterCard, meaning they can continue raising their interchange fees as they see fit. This agreement would have capped that for 5 years. And in fact, until another agreement is reached, and that could take years, by the way, especially if this goes to trial, this seems to benefit Visa rather than hurt them. I would expect an increase in their stock price. But back to that $100 billion in interchange fees paid by merchants. Notice that language, paid. This is the net revenue breakdown by segment for Visa in 2023. All those interchange fees that they collect, and I'm assuming the judge was referring to US fees, not international transaction fees, those fees go into the data processing segment. And we can see here for 2023, that was $16 billion. That's more than MasterCard, by the way. Where she's getting that $100 billion, I'm not positive. She must be getting that on top of what the banks are collecting as part of their fees too from merchants. So it does seem like Visa is getting targeted, and MasterCard, by this judge. So how has Visa performed so far in 2024? Well, like the other two, we can see they have had steady growth, especially into the trailing 12 of revenue, gross profit, and earnings. They've also increased their free cash flow on a trailing 12 basis, albeit very slightly, but it is still up. And unlike the other two, Visa has a very strong share buyback program and is one of the main ways they return capital to shareholders. Their year-to-date return for 2024 is 3.3%. Again, well under what the S&P has returned of 16.75%. So we should see a substantial increase in that return the back half of 2024, especially if they have another great earnings report like Visa always does for their next quarter, especially once the market realizes how this settlement rejection actually doesn't hurt Visa in the short term. Looking at the margins for Visa, they are a margin juggernaut. Their gross margin sits at 80% on a trailing 12 basis, and they've had a steady increase in operating margin since 2009, currently at 67% on an operating basis. Free cash flow margin has also increased substantially and is now at 57.7% on a trailing 12 basis. This means for every dollar that Visa earns, 57 cents is available to shareholders. And you can also see on a return on invested capital, it has trended very nicely upwards since 2009, sitting now at 44% on a trailing 12 basis. Visa is an absolute juggernaut, and I don't see them slowing down at all in the foreseeable future, especially with their plans for expansion into the large white space of cash transactions right now internationally. I've done a lot of videos on Visa in the past, and I've gone over their incredible economic moat and growth runway in those videos. I link them below. I'll just say that Visa is an incredible business. I like Visa so much, they're actually my second largest holding. And like the other two, Visa is a great dividend growth stock. They're currently paying a dividend of $2.08, yielding at 0.77%. You can see on a free cash flow payout percentage here, it is no problem for Visa to covering. It is consistently below 20%. And you can see the free cash flow growth compared to their dividend growth. So they have a long runway for growing that dividend. I can't say enough good things about Visa, and this little short-term blip in their share price does not concern me in the least. Visa is the only stock that I own out of the three I've discussed today, but I believe all three have great fundamentals and are poised for big second half of 2024. Intuit is actually one that I have a keen eye on and hope to initiate a position in sometime in the near future. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.